Well, good evening, ladies and gentlemen, and welcome back to Rainbow Investing, where we examine a spectrum of ideas to increase your long-term wealth. Now, tonight I just wanted to do a video on how to invest when you don't like investing. Because, let's face it, investing can be very off-putting and, dare I say, boring for many people. Now, I'm obviously not one of them. So if you think you might want to get interested in investing, make sure you subscribe on Investing in Personal Finance. And if you find this video useful, please make sure you leave a like on it. It really helps me out. So maybe you find the whole idea of investing really confusing or just really intimidating in general. You might just think of, images of stock market and stockbrokers and riding the stock exchange and all these scary sounding things, Wolf of Wall Street type of stuff. But really, investing doesn't have to be like that. There's a lot of really easy and simple ways to what we call passively invest. So that's investing without looking through numbers, without picking stocks, without doing all that kind of scary stuff. And I'm going to talk about it tonight. I think it's really important that you even just think about investing, because I think that in the future we can't really rely on just having a solid job to, get us a really comfortable living and a comfortable retirement, because we don't really know what kind of government pensions are going to be out there, or whether, how much you might have in your super fund might cut it. So I think it's really important just to dip your toe in, have a go at just some passive, easy to do investing that doesn't require much time or effort. And you might find that if you do it for a while, you might actually get more and more interested in it. But I think it's really important just to sort of dip your toe in these kind of passive investing styles, and you might find that it actually works for you. And even if it doesn't, just remember that you're putting away money that is going to earn you more money. And who doesn't want to do that? I mean, that's passive income. Because at the end of the day, that's what investing is all about, putting your money away so you get more money back in the future without having to do any physical work for it or use your time for it. Alright guys, so this is it. This is how you invest if you don't like investing, and it's through what we call index funds. So index funds might sound really complicated, but they're actually really, really simple. When you buy a share in an index fund, and you do buy shares in them, but don't be put off by that, when you buy a share in an index fund, what you're actually doing is buying a share in an index. So there are many types of indexes, but the major ones just reflect the top companies in a particular country, the top publicly traded companies. So in Australia, the most popular index is the ASX 200. So when you buy a share in an index that follows the ASX 200, what you're doing is buying a share in the top 200 companies in Australia. It's that simple. So that's everything from Commonwealth Bank to Telstra to Woolworths to Coles to Afterpay. So they're the top 200 companies in Australia, and you get a share in all of them. And your share is, so say the biggest company, you'll get more of a share in that, and the smallest one, you'll get a smaller share in that. But in one share, you're getting exposure to these top 200 companies. So you pretty much know that they've got decent businesses and they're not going to go broke because they're already in the top 200 in Australia. So, I mean, there's very little chance of a company that's already made it to the top 200 going broke. And even if it does happen, you've got 199 other companies to soften the blow. So these kinds of index funds usually will go up over the long term. And that's the key, the long term. So both the ASX 200 and the S&P 500, which is the most popular index in the world, and that follows the top 500 companies in the United States of America, they both have returned an average of about 10% since 1900. That's a rough estimate, but it's about 10%. And that's over a very, very long period of time, because as we all know, the stock market is very volatile, and it can have years where it goes up a lot, and it can have years where it crashes a lot. But over the long term, that's how much you will get roughly. It's about 10%. And just for your information, if you have your money in a fund that's returning 10%, that means you can expect your money to double in value every 7 years, roughly. So overall, an index fund is a very, very conservative investment, and it's one that will likely get you a positive return if we go by historical standards. Because 100 years is a long time, or over 100, and that's how long these index funds have been giving a positive return, on average. So if this sounds like something you might be interested in, I've got another video that explains how to do it, which I'll leave up at the top there. But just for now, index funds are a really simple and easy way to just start investing. And it's a really good way of just saving up money every 3 to 6 months and buying some more shares in these indexes. So the two I've got on the board here, IVV is the Australian version of the S&P 500, or one of them at least. So if you buy shares in IVV, it's listed on the Australian Stock Exchange, but you'll be exposed to that top 500 companies of the US, which I talked about earlier. So that includes everything from Apple to Google, Alphabet, to General Motors, to Ford. So I think the S&P 500 is a great index to start if you don't like investing. And VAS is run by a company called Vanguard, and that's an index exposed to the top 300 companies in Australia. So either of those options are really, really good indexes to follow if you don't like investing, and all you have to do is just make periodic investments in these, and it's really not hard, and you're almost certain of a return over the long term. Alright guys, thanks so much for watching. I hope you found this video useful. Make sure you leave a like on it if you do. And if you want to learn more about this kind of thing, I've got many videos that discuss this in a more in-depth way. So make sure you check those out if you found this interesting. Thank you so much for watching, and I'll see you in the next video. But for now, good night.